Hey, everybody. Welcome back to another episode of Not Financial Advice. This is Sean, and it's been a while, but today is a big update. My portfolio has finally surpassed the $100,000 mark after just a little bit over 4 years of investing in the stock market. Now, I'm not a high income earner, but a large percentage of my income goes into the market, a high savings rate. And so, I want you to stay tuned to this video because if I can do it, so can you. And I'm going to show you exactly how I've achieved this goal right after this.
You need to diversify your bonds.
The only problem you're gonna have is that you didn't buy more. Because by the time you read about it in the Wall Street Journal, it's already too late.
All right, well, if you've clicked on this video because you had an interest level of investing, or you've heard some of these phrases such as compound interest, or you've fixated on this topic of getting your portfolio to $100,000, there's certainly a good reason for it. So, due to the power of compound interest, when you hit $100,000 in your portfolio, you're actually 25% of the way from $1 million. And when you can achieve $300,000 in the market in a distance of time, you're about 53% away from reaching $1 million. And so ultimately, the goal with this portfolio is to beat the S&P 500 by a few percentage points over time and compound my wealth over time with a value and growth strategy, ultimately looking to provide passive income for myself and enable work to be something that I choose to do, not something that I have to do to pay my day-to-day expenses. So to get started, high level here, we can see that I've been tracking this accurate, most current iteration of my portfolio for the full calendar year here in 2025. Remember that this is not financial advice, so you should like the video and subscribe to the channel for more education and entertainment when it comes to stocks and the market. So, what you can see here in the blue line is my portfolio, which has risen and stayed above the S&P 500 throughout the year. So higher upsides in the blue line with lower downsides than the market. That's not so bad. And as you can see here, I'm up 7.92% this year to date to the market's 7.69%. So it's actually pretty remarkable. It's about 1.2 percentage points of outperformance over the benchmark S&P 500, which is not always easy to do. But is it a flash in the pan? Can regular people pick stocks and beat the market? Well, it's been challenging with different strategies and being less sophisticated when I first started investing to track my performance over time. I have the sense looking at bank deposits and just doing a little bit of back of the envelope math that I've probably returned about 11% year on year for the last 4 years, starting in late spring of 2021. And so also looking at the amount of money that I've reinvested that have come from dividends, that's kind of how I come to that figure. So it's cool. And a lot of people can probably beat the market for 6 or 7 months out of the year, but doing it for a year or more is more challenging, and doing it over multiple time periods is more challenging yet. So although this isn't the exact correct tracking of my portfolio, some changes have been made just to give you a sense of who you're hearing from and some of my ability to make good investment decisions, why I'm someone to potentially consider listening to. Looking over the last year of a slightly different, you can see how these numbers here haven't changed. This is very close. It just doesn't include a few $1,000s of contributions recently. But here over the last trailing 12 months, I'm up about just under 15%, where the market was under 13%. So I do have, some skill set, some ability that's a little bit more than luck. And there's a method to the madness, which I'm going to dive into and talk to you guys about now. So what we'll do is we'll look at all of my holdings, high level from the largest positions down to the smaller ones. And just to give you a sense of this, value and growth strategy, I've got about 35 individual stocks that I own, and then about 15 ETFs and index funds, sector funds, stuff like that. So going over everything, looking at this performance, you'll notice that the first holding I have is essentially VTI, or the total stock market. It's about 19% of my total holdings, where I've made $6,400 in gains, as well as about a 46% return in the time that this has been tracking accurately. Let's toggle that back on. So what you can also see here is in the current calendar year, I'm um, not only beating the S&P 500, but also showing here that I'm outperforming the Dow Jones as well as the Nasdaq and the Russell 2000. So let's look at some of these other investments. Amazon is a large piece of the puzzle, about 8 or 9% of the portfolio. And then some okay returns there that you see, but some much higher returns you're going to see in Netflix, my third largest position and a huge holding of conviction, where about half of the returns are capital appreciation. So I have a really good cost basis on that, and I'm up about 190%. Small cap value holds a place in the portfolio. It's been paying some dividends. If the Fed cuts interest rates in the future, that could do well for me. This is an asset class that just is kind of the opposite of the total market, which is large in growth. This is small in value. So it's just sort of a barbell strategy. And to capture more of that, a lot of money that is fairly on life support at the moment, large cap value strategies, VTV and SCHD, up very nominally, probably based on when I bought. Clearly, when things were, blood in the streets, I did buy other more growthy names or funds, but I also have received a healthy amount of dividends through these that have been deployed into places, for instance, like Netflix. So that's all part of the total strategy. But looking down at the rest of the portfolio, we can see Williams Sonoma up about 70%. Uber is a newer position I've held for probably about 6 months or even 4 months. I'm up nearly 40% on that. I've made $850 in that name, in that stock. Google has fluctuated throughout the years, but happy to have it as a top 10 holding. And then you can just see some ETFs there. Visa has been a really reliable compounder for me, paying a marginal dividend. Salesforce has been all over the place, up and down, but I'm happy to hold it. Again, they're near towards the top 10. A newer position is Airbnb. I've got about $2,800 in it, relatively flat, but I still feel pretty good about it. Although I will say that I'm more excited about Uber. So that could lead to some self reflection. Coinbase is an interesting one, you guys. So, as a self proclaimed acolyte of Warren Buffett, who realizes he's not Warren Buffett, but also looking at, um, different philosophies around investing. There's some people who invest, there's other people who gamble. So why not own a casino? Or when people are mining for gold, own picks and shovels. This is one I'm really proud of. It had been a larger position in the past. I actually took 100% of my capital out of this investment. So this entire $2,700 position is 100% profit, getting here towards about my top 15 holdings. So we'll go down. I've picked some different sectors, defensive sectors, to sort of balance out things like Amazon and Netflix. Here in aerospace and defense, as well as in utilities, a defensive sector, but also one with some tailwinds from AI, stuff like that. Microsoft was a more marginal position when ChatGPT came out. I was wondering or worrying if I was too late, but I wasn't. I was early. And so I probably doubled my position at this in some point, maybe about 2 years ago when we're in the tail end of a bear market, and that's done well. Happy to hold it. Facebook, it's been up much more in the past. Probably a little bit overvalued now, but good for about 64% in returns. And you can just sort of see the strategy here. Healthcare sector hasn't done great, but it holds my ground on red days and allows the compounding process to continue. International value, that was a good call of mine. Should have put more into it, will put more into it. We're kind of getting like a decade long sort of reversal with some good performance in international value stocks or international stocks in general. But here, you guys, you'll see SCHG. And what I'll do is, I think this will be one of the last major positions I talk about, and I'll just sort of fly over the rest of these. But these funds were deployed into SCHG, which is large cap growth. So names that I don't own, like Nvidia, but also more Netflix, more Amazon, Google, Apple, etc. Things like possibly Broadcom, certainly Costco, among others, are in SCHG. And when we had the tariff talks and the market went down, a flash crash, nearly 20%, I just, sort of blindly added into these positions here in SCHG. So we can look at that. Haven't held it for very long, held it for less than 3 months. I'm up 20% on the position. But I started here when the market was down 10%. I started adding. You can see gains 15, 15, 12. It goes up, it goes down. I'm adding more. These smaller amounts are dividends invested. And here's where it was the bloodiest, April 7th. It was hard, but this is what years of disciplined investing teaches you to do. When others are fearful, be greedy. So one of my largest investments was on that date, the very bottom of the market, where you can see a 35% return. Made $71 on a 200 or so dollar investment, right? So that's pretty good. And then I should have kept on buying as it continued there. The returns have been in this 20% range just in the last couple months. But you can't perfectly time the top or the bottom. All you have to do is stay invested in the market, and that's what I've done. So looking at the rest of the portfolio, Costco Caterpillar, use that to play tariffs. It's a good industrial. You buy that when the market's super bloody. I just buy big names that you usually can't afford based on valuation. But financials, Apple, Home Depot, AutoZone, cybersecurity. I bought this when I saw a really convincing deepfake AI video, and I'm like, you know what? This is maybe going to become defensive like utilities. I want to own some of this. So even though it's not a meaningful position, I'm happy to have my money into it and may add more. Uh, Healthcare. This is the largest owner of hospitals, a lot in Texas and Florida. International stocks. This is actually a gas station, Midwest Regional. I made 61 points on that mid cap stock. It's a good name. Waste Management, Zoetis Inc., which is an offshoot of Pfizer that does biotech for companion animal and farm animal. This is the one I'm adding to most recently, where I'm down about $12 on it, about a $900 position, continuing to add. I'm actually going to take a quick detour out at the end and just sort of show you why I select certain stocks over others. Zoetis is a good example of stocks I select and why. But we can just look at the rest of this. A little bit of Berkshire, TJ Maxx, Cintas. Look that one up. It's interesting. Some index funds. And these investments in cannabis to remind me how bad of an investor I once was. And then a little marginal thing that I couldn't figure out a way to liquidate. So there it is, 107.2 thousand portfolio. Took about 4.25 years, 4.1 years. And we'll come over here to Qualtrim real quick. This is a suite of software that I pay for, not one I'm affiliated with. But some of these ways in which I pick stocks, so you can sort of see the PE range in that mid 20s is pretty comfortable. Free cash flow in the 3% yield area is pretty good. And I just look at these things. So top line revenue growth. This is just a fast checklist. So top line revenue growth around 7 or 8%. It's not so bad. Cash flow up and to the right. Growth probably in this 20% range. When you look sort of here and you look there, I'm seeing free cash flow growth in the 20% range. That rocks. EPS growth as well as cash flow. EPS will move it in the short term. Cash flow will move it in the long term, or so they say. EPS growth in the low double digits is pretty okay. What might be a little bit more on the value side with free cash flow. That mid or high teen EPS grower can really drive explosive returns. But you see some debt coming down with a good amount of cash, good capitalization for this type of business. They buy back shares. They have high returns on invested capital and more. So that's Zoetis. I always wanted to own like a pet food company, but I could never find anything at that valuation. I know millennials and other people treat pets like people and the humanization of pets. It's just a sector that I wanted to be exposed to. And it took 4 years to find this awesome stock, but one that I'm going to continue to grow into. As the free cash flow, revenue, and earnings per share numbers go up, so will the stock price over time. If for whatever reason it doesn't after 3 years, maybe I'll cut my losses. But that's sort of the things that have got me gains in companies like Netflix, among others, is profitability, stuff like that. So guys, thanks so much for tuning in. This is Sean with Not Financial Advice. Make sure to hit like on the way out as well as subscribe, and I will see you on the next one.